The global economy looks stable. Markets are calm. Corporations report record profits. Governments speak of resilience and soft landings. But stability today does not mean health. It means intervention. What you are seeing is not a self-sustaining system, but one that survives through constant support, hidden subsidies, and artificial profits. Growth exists, but it is engineered. Profits exist, but they are constructed. And the most dangerous thing about this moment is not collapse. It is comfort. Because systems rarely fail when they look weak. They fail when everyone believes they are under control. The global economy, at first glance, appears calm, resilient, and even confident. Stock indices hover near historical highs. Corporate earnings calls are filled with carefully measured optimism. Central bankers speak the language of balance and control, and governments repeat the same reassuring vocabulary. Stabilization, normalization, soft landing. News headlines rotate between minor shocks and quick recoveries, reinforcing the idea that the system, though strained, remains fundamentally sound. This perception is not accidental. It is the product of narrative management, selective data emphasis, and a statistical architecture designed to smooth volatility rather than reveal structural weakness. In recent months, major financial centers have celebrated declining headline inflation rates, pointing to easing energy prices, normalized supply chains, and moderating consumer demand. Markets respond predictably. Equities rally, volatility indexes fall, risk appetite returns. Yet beneath this surface, real economic conditions tell a far less comforting story. Household purchasing power remains compressed. Productivity growth in advanced economies continues to stagnate, and corporate investment into long-term capacity quietly retreats. The contradiction is striking. Confidence rises while foundations erode. Gross domestic product growth is frequently cited as proof of recovery. However, modern GDP accounting increasingly captures activity without distinguishing between productive expansion and compensatory spending. Government outlays funded by borrowing, emergency programs extended indefinitely, and price level increases all contribute to nominal growth figures. When adjusted for inflation methodologies that systematically underweight essential costs such as housing, healthcare, and education, real growth shrinks dramatically. In several major economies, real GDP per capita has barely advanced since before the last global crisis, yet the aggregate numbers suggest progress. This divergence is not a statistical error, it is a feature. Labor market data offers a similar illusion. Employment rates are reported as strong, unemployment as low, participation as stable. But these figures mask a transformation in job quality. Full-time, high-productivity employment is increasingly replaced by precarious service work, temporary contracts, and multiple job holding. Wage growth lags behind cumulative price increases, resulting in real income compression despite nominal raises. Official statistics register employment, not security. They record jobs, not stability. Financial markets amplify the illusion. Equity valuations are often justified by expectations of future earnings growth, yet those expectations rely heavily on assumptions of continued monetary support and fiscal intervention. When central banks signal patience or flexibility, markets interpret it as a guarantee rather than a conditional response. Bond yields move not on the strength of economic fundamentals, but on subtle shifts in central bank language. The pricing of risk becomes detached from the underlying capacity of the economy to generate real value. Corporate balance sheets appear strong, but this strength is frequently financial rather than operational. Cash reserves are inflated by debt issuance during years of ultra-low interest rates. Share prices are supported by aggressive buyback programs rather than revenue expansion. Investment in research, infrastructure, and workforce development remains cautious, reflecting management skepticism about long-term demand. Public confidence in corporate health rests on metrics that reward short-term optimization over structural resilience. Global trade figures further reinforce the narrative of stability. Volumes recover after disruptions. Shipping costs normalize. Inventories rebuild. Yet trade growth increasingly reflects reshuffling rather than expansion. Supply chains are reoriented for political resilience, not efficiency. Redundancy replaces optimization, increasing costs while maintaining volume. Trade flows remain active, but the value created per unit of trade declines. The system moves more to achieve less. Central banks occupy the core of this illusion. Their communications are carefully calibrated to project control over inflation, growth, and financial stability simultaneously. Interest rate decisions are framed as data dependent, yet the data itself is shaped by prior interventions. Liquidity facilities, designed as temporary safeguards, become permanent features. Balance sheets shrink symbolically, while alternative mechanisms expand quietly. The promise of normalization persists, even as the system demonstrates its inability to function without continuous support. Global news cycles contribute to the perception of resilience by fragmenting attention. Crises are presented as isolated events: a regional banking failure contained, a currency shock absorbed, a geopolitical disruption priced in. Each incident is resolved within the narrative before its systemic implications are explored. Viewers are conditioned to expect recovery as the default outcome, not as an achievement requiring structural reform. What emerges is not a stable economy, but a stable story. A story maintained through coordinated messaging, selective metrics, and financial mechanisms that delay adjustment rather than prevent it. Stability becomes an aesthetic, not a condition. It is measured by market calm rather than economic health, by sentiment rather than sustainability. For investors and policymakers alike, this illusion is both comforting and dangerous. It reduces urgency, discourages reform, and rewards continuation over correction. The longer it persists, the more fragile the system beneath it becomes. True stability requires alignment between financial signals and real economic capacity. What exists today is alignment between perception and narrative control. Understanding this distinction is the first step towards seeing the modern global economy clearly, not as a system healed, but as one anesthetized. Not as balanced, but as carefully suspended. The calm is real, but it is manufactured. And like all manufactured stability, it depends on constant maintenance, growing intervention, and the quiet assumption that tomorrow will tolerate what today cannot resolve. What sustains the appearance of a functioning global economy is no longer productivity, innovation, or competitive efficiency. It is an expanding lattice of subsidies, guarantees, preferential access, and indirect state support that operates beneath the surface of official balance sheets. This architecture is rarely discussed openly, not because it is secret, but because acknowledging its scale would undermine the idea that modern economies still operate on market logic. What exists today is not a free market corrected by the state, but a state-dependent market maintained through continuous intervention. Subsidies are often imagined as direct transfers, checks written by governments to struggling industries. In reality, the most powerful forms of support are indirect and structurally embedded. Preferential lending terms, regulatory exemptions, implicit guarantees, tax deferrals, price floors, emergency facilities, and selective enforcement create economic outcomes that would not exist under neutral conditions. These mechanisms do not appear as subsidies in public discourse, yet their impact exceeds traditional support programs by orders of magnitude. The energy sector provides a clear example. While governments publicly promote market pricing and competition, energy producers across major economies operate within frameworks of guaranteed demand, strategic reserves, price stabilization mechanisms, and emergency compensation schemes. When prices spike, consumers are shielded through caps and rebates. When prices collapse, producers receive relief through tax credits, accelerated depreciation, and state-backed financing. Risk is socialized on both ends, while profits remain private during periods of stability. This dual protection ensures continuity, but it also eliminates genuine price discovery. Banking operates even further from market discipline. Large financial institutions benefit from an implicit guarantee that predates any formal crisis response. Deposit insurance schemes, lender of last resort facilities, and emergency liquidity windows ensure that failure is contained before it becomes visible. During periods of stress, central banks expand collateral definitions, relax capital requirements, and provide funding at rates unavailable to private actors. These actions are framed as stability measures, yet they function as continuous subsidies to leverage. Banks are not rewarded for prudence, but for size and systemic importance. Transportation and logistics reveal a similar pattern. Airlines, shipping companies, and rail operators are repeatedly described as strategic assets. Losses are absorbed during downturns through bailouts, wage support programs, fuel subsidies, and debt guarantees. Profits during upcycles are rarely reclaimed. The justification is continuity of service and national interest, but the effect is persistent distortion. Capital flows toward protected incumbents rather than efficient challengers. Innovation slows, consolidation accelerates, and dependency deepens. Agriculture has long existed within a subsidy framework, Yet its scales expanded far beyond food security. Price supports, insurance schemes, export credits, and input subsidies stabilize incomes regardless of market demand. While this ensures supply continuity, it also locks in inefficient practices and suppresses price signals that would otherwise encourage adaptation. Consumers pay indirectly through taxes and environmental degradation, while the market narrative remains intact. Technology, often portrayed as the purest expression of innovation, is increasingly subsidy dependent. Research grants, tax incentives, public procurement contracts, and preferential regulatory treatment underpin the valuation of major firms. Infrastructure, such as data centers, semiconductor fabrication, and network expansion, relies heavily on public funding and political prioritization. Strategic competition between states accelerates this trend, transforming technology markets into arenas of geopolitical subsidy races rather than competitive ecosystems. What unites these sectors is not failure, but indispensability. Once the industry is deemed too important to fail, it becomes too important to discipline. Losses are absorbed, risks are muted, and inefficiencies accumulate. The market no longer selects winners. Policy does. Over time, economic survival depends less on performance and more on proximity to state support structures. Fiscal policy reinforces this system through permanent emergency. Programs introduced as temporary responses become normalized. Budget deficits are justified as investments, stimulus, or resilience measures. Public debt expands without a credible path to reduction, supported by the assumption that growth, inflation, or financial repression will manage the burden. Subsidies are not reversed, because reversal would reveal dependence. The true scale of this architecture is difficult to quantify, precisely because it is dispersed across balance sheets, regulations, and contingent liabilities. However, estimates consistently show that implicit guarantees and indirect support exceed direct spending by several multiples. The economy functions not because it is strong, but because it is continuously stabilized. This hidden architecture creates a paradox. It reduces volatility in the short term while increasing fragility in the long term. By preventing failure, it prevents learning. By suppressing signals, it delays adjustment. Stability is achieved not through balance, but through accumulation of unresolved pressure. The first part of understanding the modern economy is recognizing that what appears as market activity is often policy execution in disguise. Prices move, profits form, and capital flows, but the underlying logic is administrative rather than competitive. The system survives not because it adapts, but because it is held together. And the more it is held together, the harder it becomes to let go. As this architecture of hidden support expands, its secondary effects begin to reshape the behavior of every participant within the system. Companies, investors, governments, and households gradually adapt not to market conditions, but to the expectation of intervention. Decision-making shifts from assessing risk to anticipating policy response. The central question is no longer whether an activity is economically viable, but whether it is politically tolerable to allow it to fail. Corporations internalize this logic quickly. Capital allocation strategies are adjusted to maximize eligibility for support rather than efficiency. Investment decisions prioritize sectors labeled strategic, sustainable, or systemically important, not because of superior returns, but because of reduced downside risk. When losses are cushioned and financing is guaranteed, the incentive to innovate weakens. Margins are protected not through productivity gains, but through regulatory positioning and financial structuring. Over time, corporate behavior converges toward rent-seeking rather than value creation. Investors respond rationally to these incentives. Capital flows increasingly favor assets backed implicitly or explicitly by the state. Sovereign bonds, systemically important financial institutions, defense contractors, regulated utilities, and subsidized technology platforms attract disproportionate valuation premiums. Risk models incorporate not economic fundamentals, but the probability of rescue. Market pricing ceases to function as a signal of underlying health and becomes a referendum on political commitment. Volatility declines not because risk disappears, but because it is transferred. This transfer is neither neutral nor costless. It shifts instability away from balance sheets and into society. Inflation becomes a substitute for restructuring, eroding purchasing power without triggering formal defaults. Asset price inflation benefits those with capital exposure, while wage earners absorb the adjustment through rising living costs. Inequality widens not as a moral failure, but as a mechanical outcome of subsidy-driven systems that favor scale, leverage, and proximity to power. Governments themselves become trapped by the systems they construct. Each intervention raises the baseline of acceptable support. What was once extraordinary becomes expected. Withdrawal becomes politically dangerous and economically destabilizing. Policymakers face a narrowing set of choices: intervene again, intervene earlier, or intervene more aggressively. Fiscal space erodes, but credibility depends on maintaining the appearance of control. Public debt grows not because of ambition, but because retreat is no longer an option. Monetary authorities face a similar constraint. Interest rates cannot normalize without destabilizing debt-laden structures built during years of accommodation. Balance sheets cannot contract meaningfully without disrupting asset markets dependent on liquidity. Central banks communicate flexibility as prudence, but flexibility becomes dependence. Markets listen not for guidance, but for reassurance. Silence itself becomes a signal of concern. Internationally, these dynamics propagate instability rather than contain it. Countries with reserve currencies export adjustment costs through capital flows and exchange rate pressure. Developing economies experience volatility as global liquidity surges and retreats in response to policy shifts in advanced economies. Subsidy-driven competition intensifies as states respond to one another's interventions to avoid relative disadvantage. The global economy fragments into zones of protection rather than integration. World news increasingly reflects this tension. Trade disputes framed as security concerns. Industrial policy justified as resilience. Financial rescues described as precautionary. Each narrative normalizes intervention while obscuring dependence. Crises appear smaller and more frequent, resolved quickly but never conclusively. The system moves from shock to shock, stabilized each time, weakened cumulatively. The long-term consequence is a profound misallocation of resources. Capital remains tied to legacy structures, while emerging needs remain underfunded. Productivity stagnates because inefficiency is tolerated. Growth persists only through expansion of support, rather than expansion of capacity. The economy grows heavier without becoming stronger. This is the hidden cost of stability. By shielding the system from correction, subsidies prevent renewal. By protecting incumbents, they suppress challengers. By managing outcomes, they eliminate discovery. What remains is an economy that functions operationally but decays structurally. Understanding this reality requires abandoning the comforting distinction between market and state. They are no longer separate spheres. They are fused into a single mechanism where policy defines possibility and economics rationalizes it after the fact. The hidden architecture of subsidies is not a temporary scaffold. It is the load-bearing structure itself. And any structure that depends on continuous reinforcement eventually reaches a point where reinforcement becomes indistinguishable from collapse prevention. At that moment, stability is no longer a sign of health. It is a warning. Corporate profits today appear stronger, cleaner, and more resilient than at almost any point in modern economic history. Earnings reports repeatedly exceed expectations. Margins remain elevated despite rising costs, and equity valuations imply confidence in long-term growth. Yet this apparent strength masks a fundamental transformation in how profits are generated. What looks like operational success is increasingly the result of financial engineering, accounting elasticity, and balance sheet manipulation, rather than genuine expansion of productive capacity. Over the past decade, profit growth in many advanced economies has decoupled from revenue growth and productivity gains. Companies report higher earnings even as unit sales stagnate and real investment slows. This divergence is not accidental. It reflects a strategic shift toward extracting value from financial structures rather than creating it through production. Profits are no longer primarily earned, they are constructed. One of the most visible mechanisms is the systematic use of share repurchases. Corporate buyback programs have reached unprecedented scale, absorbing vast portions of free cash flow and borrowed capital. By reducing the number of shares outstanding, companies mechanically increase earnings per share without improving underlying performance. Executive compensation structures tied to share price and per-share metrics reinforce this behavior. Capital that might otherwise fund innovation, workforce development, or long-term resilience is redirected toward market optics. The company appears more profitable while its productive base quietly erodes. Debt plays a central role in this process. Years of exceptionally low interest rates encourage corporations to leverage aggressively, not to expand operations, but to optimize capital structures. Borrowed funds were frequently used to refinance equity, fund buybacks, or engage in mergers designed to boost short-term metrics. Balance sheets expanded, but capacity did not. The risk associated with this leverage remains latent, manageable only as long as refinancing conditions remain favorable and revenues do not contract meaningfully. Accounting practices further amplify the illusion. Depreciation schedules are extended, impairment charges delayed, and one-time items normalized. Adjusted earnings metrics exclude recurring expenses labeled as exceptional. These techniques are legal, standardized, and widely accepted, yet their cumulative effect is to smooth performance and suppress volatility. Financial statements become instruments of narrative continuity rather than transparent records of economic activity. The structure of modern conglomerates intensifies this effect. Complex corporate entities allocate costs and revenues across jurisdictions to minimize tax exposure and maximize reported profitability. Intellectual property is housed in favorable locations. Transfer pricing redistributes income internally, and tax credits further enhance net results. Profitability reflects legal architecture as much as market success. National statistics capture the profits, but not their origins. Global news regularly highlights record corporate profits alongside subdued wage growth and weak capital expenditure. This juxtaposition is often explained as efficiency, but efficiency without reinvestment is extraction. When profits are not recycled into productive activity, they cease to represent economic health and instead signal imbalance. The firm becomes a financial vehicle rather than a productive organism. Financial markets reward this behavior. Valuations favor predictability over growth, margin stability over expansion, and capital discipline over risk-taking. Analysts praise companies for returning capital to shareholders rather than deploying it. Volatility reduction becomes a primary objective. The market evolves into a system that prices financial behavior rather than economic contribution. This dynamic extends beyond individual firms to entire sectors. Technology companies generate enormous profits through platform dominance and network effects, yet marginal productivity gains decline. Industrial firms maintain margins through consolidation and pricing power rather than innovation. Consumer goods companies rely on brand leverage and incremental price increases rather than volume growth. Across sectors, profits persist even as the economic frontier stagnates. Central banks indirectly reinforce these dynamics. By suppressing systemic risk and stabilizing asset prices, they reduce the penalty for financial optimization. Market corrections that might otherwise discipline excess leverage or inefficient capital allocation are softened or reversed. The signal that failure is tolerable disappears. Profit becomes detached from risk. The result is a corporate sector that appears robust but behaves defensively. Investment horizons shorten. Research budgets become discretionary. Labor is treated as a variable cost rather than a source of productivity. Profit maximization becomes synonymous with balance sheet management rather than economic leadership. This is the first layer of artificial profitability. It does not rely on fraud or deception, but on incentives structured to reward appearance over substance. Companies respond rationally to the environment they inhabit. They optimize for metrics that markets, regulators, and policymakers prioritize. In doing so, they collectively transform profit from a signal of success into a manufactured outcome. What remains unresolved is the cost. Financial engineering does not eliminate economic constraints, it postpones them. Leverage accumulates, assets age, skills stagnate, and resilience declines. The system appears stable precisely because its weaknesses are hidden behind accounting precision and market confidence. Understanding this transformation is essential to understanding modern capitalism. Profit still exists, but it no longer tells the truth. It speaks the language of finance, not the reality of production. And as long as artificial profitability is rewarded, real economic strength will remain secondary. This is not a crisis, it is a condition. And conditions, unlike shocks, persist until the environment that sustains them changes. The deeper consequence of artificial profitability is not merely distortion at the firm level, but a systemic redefinition of what success means across the entire economy. When profits can be generated independently of productive contribution, the feedback loop that once disciplined capitalism breaks down. Markets stop distinguishing between efficiency and extraction, between innovation and optimization, between resilience and cosmetic strength. Profit remains visible, but information content collapses. At the macro level, this shift becomes evident in productivity data. Across advanced economies, productivity growth has trended downward for years, despite rapid technological advancement and record corporate earnings. This is not a paradox. Productivity reflects output per unit of input, not financial returns per unit of leverage. When capital is allocated toward buybacks, mergers, and balance sheet optimization, measured productivity stagnates even as profits rise. The economy becomes financially efficient and economically inefficient at the same time. Capital expenditure trends reinforce this pattern. Corporate investment as a share of profits remains subdued, even during periods of high earnings and favorable financing conditions. Firms prefer optionality over commitment. New factories, supply chain redesign, workforce reskilling, and long horizon research carry uncertainty that financial markets no longer reward. The expected return on real investment is discounted relative to the certainty of engineered earnings. As a result, capacity growth lags demand, reinforcing inflationary pressure and further justifying price increases that sustain margins without expansion. Labor bears a disproportionate share of this adjustment. Wages are treated as costs to be managed rather than investments to be cultivated. Automation and outsourcing are pursued not to increase output, but to protect margins. When productivity gains do occur, they are rarely shared proportionally with workers. This suppresses aggregate demand and reinforces reliance on credit and asset inflation to sustain consumption. Profitability persists, but its foundation narrows. Financial reporting adapts accordingly. Forward guidance emphasizes stability, visibility, and predictability. Uncertainty is framed as risk to be avoided rather than opportunity to be seized. Earnings calls become exercises in expectation management rather than strategic vision. Language converges across industries, reflecting not coordination, but shared incentives. Markets reward those who conform. At the system level, this behavior compounds fragility. Artificial profitability depends on stable financing conditions, cooperative monetary policy, and uninterrupted access to capital markets. Any disruption to these pillars exposes the underlying weakness quickly. When interest rates rise, refinancing becomes costly. When liquidity tightens, buybacks slow. When revenues dip, leverage amplifies stress. The same mechanisms that inflated profits accelerate contraction. Global events periodically test this structure. Supply chain disruptions, geopolitical shocks, and financial stress episodes reveal how little slack exists beneath the surface. Firms that appear strong struggle to adapt quickly because adaptability was sacrificed for efficiency. Inventories are lean, labor is flexible but disengaged, and investment pipelines are thin. Resilience has been optimized out. Yet markets often interpret these moments not as warnings, but as opportunities for further intervention. Declines in asset prices trigger expectations of policy response. Losses are framed as temporary dislocations rather than signals of misallocation. The corrective function of downturns is muted. Artificial profitability survives by being reinforced precisely when it should be questioned. This feedback loop reshapes investor psychology. Long-term valuation becomes less relevant than short-term policy sensitivity. Risk assessment shifts from business models to central bank behavior. The distinction between investing and positioning blurs. Capital flows chase narratives of protection rather than prospects of growth. The market evolves into a policy derivative. Over time, this environment produces a quiet erosion of entrepreneurial dynamism. New entrants struggle to compete against incumbents whose profitability is underwritten by scale, leverage, and regulatory familiarity. Innovation becomes incremental, focused on sustaining dominance rather than disrupting it. Creative destruction slows, replaced by managed continuity. The cost of this transformation is not immediately visible because artificial profitability masks decline. Assets retain value, incomes persist, and institutions function. But beneath this surface, economic adaptability weakens. When change eventually arrives, it arrives abruptly, because gradual adjustment was postponed too long. Artificial profits are therefore not an accounting curiosity. They are a systemic condition with far-reaching implications. They distort signals, misallocate capital, suppress productivity, and weaken resilience. They create an economy that appears prosperous while becoming brittle. Understanding this reality requires abandoning the assumption that profit equals health. In the modern system, profit increasingly reflects access to financial tools rather than contribution to economic capacity. It is less a reward for value creation and more a symptom of structural accommodation. This does not mean profitability will disappear. It means it will persist until the conditions that sustain it no longer hold. And when those conditions change, the adjustment will not be gentle, because the system has forgotten how to adapt without intervention. Artificial profitability is not the cause of instability. It is the evidence of it. The question that ultimately defines any economic system is not how growth is produced, but who absorbs the cost of maintaining it when growth becomes artificial. In the modern global economy, the answer is diffused by design. The burden is distributed across households, taxpayers, future generations, and peripheral economies in ways that are difficult to trace, easy to deny, and politically convenient to ignore. Stability is preserved precisely because its price is fragmented. Households experience this cost first, though rarely in ways explicitly labeled as economic sacrifice. The most common mechanism is inflation. Rather than allowing inefficient structures to fail and reset, policymakers permit prices to rise gradually, eroding purchasing power without triggering formal defaults or political crises. This process operates silently. Nominal wages increase, employment remains statistically strong, and consumption persists, yet real living standards stagnate or decline. Essentials such as housing, healthcare, energy, and education absorb a growing share of income, leaving discretionary spending compressed. The system remains functional, but only by lowering expectations. This adjustment is often described as resilience. In practice, it is endurance. Households compensate by increasing debt, drawing down savings, or working longer hours. Labor force participation appears healthy, yet multiple job holding rises. Economic participation intensifies not because opportunity expands, but because security contracts. The economy does not collapse, it tightens. Taxpayers bear the cost through fiscal expansion disguised as necessity. Government budgets absorb losses that markets no longer price. Bailouts are rebranded as support, guarantees as insurance, deficits as investments. Public debt accumulates not in response to extraordinary ambition, but as the baseline condition of maintaining existing structures. Debt servicing costs are managed through low interest rates, financial repression, or inflationary erosion. The true expense is deferred, spread over time, and rendered abstract. This abstraction is critical. Unlike direct taxation, debt finance stabilization lacks immediacy. There is no clear transaction between policy choice and personal cost. The result is a widening gap between economic reality and public perception. Citizens experience pressure but cannot easily attribute it to specific decisions. Accountability dissolves into complexity. Future generations inherit the most rigid version of this burden. High debt levels constrain fiscal flexibility, limiting responses to new crises. Infrastructure ages, social systems strain, and demographic pressures intensify. Younger cohorts enter economies where asset prices are elevated, real wages are constrained, and opportunity depends increasingly on inherited capital rather than productivity. The cost of past stability becomes a structural ceiling on future mobility. This intertemporal transfer is rarely acknowledged explicitly. It is justified implicitly through narratives of growth, innovation, and resilience. Yet growth that relies on continuous support rather than capacity expansion does not generate the surplus required to offset its own cost. The bill does not disappear, it accumulates. Internationally, the burden shifts unevenly across borders. Economies with reserve currencies externalize adjustment through capital flows, trade imbalances, and monetary transmission. When liquidity expands, capital seeks yield abroad, inflating asset prices and destabilizing local markets. When conditions tighten, capital retreats, triggering currency pressure, inflation, and financial stress in developing economies. These cycles are described as volatility, but they are the global expression of subsidy-driven stability at the core. Global news increasingly reflects this imbalance. Currency crises framed as domestic mismanagement, debt distress attributed to governance failures. Yet the underlying mechanism is systemic. Peripheral economies absorb shocks generated elsewhere, without access to the tools required to neutralize them. Stability at the center depends on flexibility at the edges. Even within advanced economies, the distribution of cost is asymmetric. Asset holders benefit from policies that support valuations, while wage earners face price pressure. Pension funds appear solvent due to inflated asset prices, masking long-term sustainability issues. Savings retain nominal value while losing real purchasing power. The system rewards ownership over participation. This redistribution is not accidental. It reflects the mechanics of intervention. Policies that stabilize markets do so by preserving asset values. Those without assets receive stability only indirectly, through employment continuity and social transfers that lag inflation. The gap widens quietly, normalized by gradualism. The political economy adapts accordingly. Discontent rises but remains fragmented. Economic frustration expresses itself culturally rather than structurally. Policy debate focuses on symptoms rather than causes. Each group experiences pressure differently, preventing collective recognition of the underlying trade-off. Stability persists not because it is fair, but because it is opaque. What makes this arrangement durable is its incremental nature. No single decision imposes unbearable cost. Each intervention appears justified. Each adjustment seems manageable. Yet cumulatively, the system transfers risk downward and forward, insulating institutions while exposing individuals. This is the true price of artificial stability. It is not paid in one moment or by one group. It is paid continuously, diffusely, and invisibly. The economy functions, but it does so by consuming resilience rather than building it. Understanding who pays requires looking beyond aggregate indicators. It requires tracing how costs are displaced rather than resolved. And once that displacement becomes clear, the illusion of neutral stability dissolves. What remains is a system that survives by redistributing strain, not by eliminating it. And that strain does not vanish. It waits. As these costs accumulate, their interaction produces secondary effects that reshape social structure, political incentives, and economic behavior in ways that are difficult to reverse. The system does not merely transfer burden. It conditions society to adapt to permanent pressure. What begins as economic adjustment evolves into normalization of decline masked as continuity. Households adjust expectations downward. Ownership becomes aspirational rather than attainable. Long-term planning gives way to short-term survival strategies. Savings rates fluctuate, not because confidence improves, but because uncertainty forces precaution. Consumption remains resilient only because it is increasingly decoupled from income through credit, asset liquidation, or intergenerational transfers. The appearance of demand persists, but its quality deteriorates. Spending reflects necessity, not confidence. Social mobility slows as asset inflation outpaces wage growth. Entry barriers rise quietly. Housing markets exemplify this shift. Prices remain elevated due to low effective supply, financialization, and policy protection, while affordability declines. Younger cohorts are priced out not by scarcity alone, but by the monetization of stability itself. Housing becomes both shelter and financial instrument, protected because its failure would destabilize the broader system. The cost is exclusion. Education and healthcare follow similar trajectories. Public provision strains under fiscal pressure, while private alternatives expand for those who can afford them. Access becomes stratified. Opportunity fragments. Inequality deepens not primarily through income gaps, but through differential exposure to risk and access to buffers. The economy remains operational, but its social contract thins. Politically, this environment rewards short horizons. Policymakers prioritize measures that prevent immediate disruption over reforms that impose near-term cost for long-term gain. Structural correction becomes politically irrational. Any attempt to reduce support risks visible pain, while continuation spreads discomfort invisibly. Stability becomes the dominant metric of success, even as progress stalls. Public discourse adapts accordingly. Economic debates focus on managing outcomes rather than redesigning systems. Inflation targets replace productivity goals. Employment figures substitute for job quality. Growth is discussed without reference to its composition. Complexity shields decision-makers from accountability. Citizens sense decline but lack a clear narrative that connects their experience to policy choices. Financial markets reinforce this equilibrium. Asset prices act as a proxy for confidence, and confidence becomes a policy objective. Corrections are feared not because they destroy value, but because they reveal fragility. As a result, volatility suppression becomes a public good. Risk is priced out of markets and reintroduced into society through living costs, precarity, and insecurity. This dynamic creates a feedback loop between economic management and social tolerance. As societies absorb more pressure without overt crisis, policymakers gain justification for further intervention. Each successful containment raises the threshold for what is considered acceptable strain. What once would have provoked reform now registers as background noise. Internationally, divergence accelerates. Economies with strong institutions and reserve currencies continue to defer adjustment, while others confront it directly through austerity, devaluation, or default. Global inequality widens, not only between individuals, but between systems. Stability becomes a privilege, not a norm. Global news increasingly reflects this fragmentation. Protests framed as cultural unrest, elections interpreted as populist swings, policy volatility attributed to polarization. Yet beneath these narratives lies a common economic substrate: societies reacting to sustained pressure without structural relief. Politics becomes the language through which economic stress is expressed when economics no longer provides solutions. Over time, resilience erodes. Systems designed to absorb shocks lose flexibility. Emergency tools become routine. Fiscal and monetary space narrows. When genuine shocks arrive, responses are constrained not by lack of knowledge, but by exhaustion of capacity. The margin for error shrinks. This is the long shadow of artificial stability. It preserves form while hollowing substance. Institutions remain, but trust weakens. Markets function, but signals degrade. Growth continues, but opportunity contracts. The economy survives, but at the expense of adaptability. Ultimately, the question of who pays is inseparable from the question of how long payment can be deferred. Costs pushed downward and forward do not disappear. They accumulate until they intersect with limits, political, social, or financial. At that intersection, stability ceases to be a buffer and becomes a constraint. Understanding this dynamic is not an exercise in pessimism. It is an exercise in clarity. Systems that rely on invisible sacrifice cannot renew themselves indefinitely. The longer the cost remains obscured, the sharper the adjustment when it emerges. The economy, in this sense, is not failing. It is consuming its future to preserve its present. And consumption, unlike investment, always runs out. Every system that survives by deferring correction eventually confronts the question it has spent years avoiding. What happens when continuation itself becomes unsustainable? The modern global economy now exists within that narrow corridor, not at the point of collapse, but at the point where every available path forward carries visible cost. The endgame is not a single outcome. It is a constrained set of scenarios shaped by accumulated imbalances, political limits, and institutional fatigue. The first scenario is prolonged stagnation disguised as stability. In this path, growth persists nominally, but weakens structurally. Output expands slowly, productivity remains subdued, and living standards plateau. Inflation oscillates around elevated levels, not because demand is strong, but because supply remains constrained and adjustment is incomplete. Governments maintain support mechanisms indefinitely, reframing them as structural features rather than emergency tools. Markets adapt to lower real returns, pricing assets on the assumption of permanent intervention. This scenario avoids dramatic rupture, but it extracts a steady toll in the form of lost opportunity, declining mobility, and persistent inequality. Historical precedent suggests this outcome is plausible. Extended periods of low growth, combined with high debt, have occurred before, often following large-scale disruptions. What distinguishes the current environment is the global synchronization of this condition. With major economies moving in parallel, external demand cannot compensate for internal weakness. Growth becomes endogenous to policy rather than innovation. Time passes, institutions endure, but momentum fades. The second scenario is sudden disruption triggered by a shock that overwhelms containment capacity. This shock need not originate within the financial system. It may emerge from geopolitics, energy markets, climate-related events, or demographic stress. The critical factor is not the source, but the context. With leverage elevated, buffers thin, and policy space constrained, the system's tolerance for surprise is low. What might once have been absorbed now cascades. In this scenario, confidence breaks before institutions fail. Asset prices reprice rapidly as assumptions about support are questioned. Liquidity tightens not because it disappears, but because it is hoarded. Capital flows reverse abruptly. Governments respond, but with diminished credibility. Interventions stabilize fragments, but not the whole. Adjustment accelerates because it can no longer be postponed. The correction is sharp, not because it is large, but because it is delayed. The third scenario is controlled restructuring through gradual devaluation and systemic reset. This path involves deliberate acceptance of loss spread over time. Inflation is tolerated above target, Currencies weaken in managed fashion. Debt burdens are reduced through erosion rather than default. Asset values stagnate in real terms while nominal stability is preserved. This approach minimizes visible crisis at the cost of prolonged compression. It requires coordination, patience, and political discipline. It also requires public acquiescence to lower expectations. This scenario is often presented as pragmatic realism. It avoids the stigma of crisis while achieving adjustment incrementally. However, its success depends on trust in institutions and shared understanding of sacrifice. Without credibility, gradualism becomes drift. Without transparency, it becomes resentment. Across all scenarios, one constraint remains constant. The system cannot return to a prior equilibrium without relinquishing some of the protections it has accumulated. There is no path back to a self-correcting market environment without enduring short-term pain. The choice is not between pain and comfort, but between visible pain now and diffuse pain later. Global developments increasingly reflect this tension. Industrial policy expands as states compete to secure supply chains. Trade relationships fragment under the weight of security concerns. Financial regulation tightens selectively, targeting symptoms rather than structure. These moves are defensive rather than transformative. They signal preparation for endurance, not renewal. Markets respond by narrowing their focus. Long-term growth narratives lose influence. Short-term policy signals dominate. Valuations compress, not through collapse, but through reduced ambition. Risk premiums adjust upward quietly. Capital becomes cautious, not fearful. This is not panic. It is resignation. At the institutional level, credibility becomes the most valuable asset. Central banks, treasuries, and regulators operate within shrinking margins. Each action must balance economic necessity against political feasibility. Communication grows more complex as certainty declines. Language shifts toward flexibility, optionality, and resilience. Precision gives way to adaptability. The endgame, then, is not a single event. It is a process of constraint recognition. The system continues to function, but within tighter bounds. Choices that were once discretionary become forced. Trade-offs that were once abstract become personal. Stability remains the objective, but its meaning changes. It no longer implies progress. It implies avoidance of collapse. For investors, this environment demands recalibration. Returns become asymmetric. Preservation rivals growth. Risk assessment centers on regime durability rather than expansion potential. For businesses, strategy shifts from scaling to survival, from disruption to positioning. For policymakers, success is measured not by outcomes achieved, but by disasters averted. The illusion that one sustained confidence gives way to a more sober understanding. The economy is not broken, but it is constrained. Its future is not catastrophic, but it is limited. Growth exists, but it is conditional. Stability persists, but it is costly. This recognition marks the true beginning of adjustment. Not when crisis arrives, but when continuation is no longer mistaken for health. The endgame does not announce itself loudly. It reveals itself quietly, through narrowed options and lowered expectations. And in that quiet narrowing, the question shifts. Not how to grow faster, but how to choose what to preserve. As the system moves deeper into this constrained phase, its defining feature becomes adaptation without renewal. Institutions learn how to function under pressure, but not how to escape it. The mechanisms that once postponed adjustment now shape behavior permanently. What was temporary becomes structural, and the distinction between emergency management and long-term policy dissolves. Economic decision-making narrows. Governments prioritize predictability over experimentation. Fiscal policy focuses on cushioning rather than transformation. Large-scale reforms are discussed but delayed, announced but diluted. Each reform carries transitional cost, and transitional cost has become politically unacceptable. Stability is treated as a public good that must be defended at all costs, even if that defense prevents regeneration. This environment alters how societies interpret risk. Risk is no longer associated with innovation or change, but with disruption of existing arrangements. Stability itself becomes fragile, not because it is weak, but because it is overprotected. The more the system depends on intervention, the less resilient it becomes to the absence of it. Optionality declines. Every policy choice tightens constraints elsewhere. Demographics intensify this pressure. Aging populations increase dependency ratios, strain pension systems, and reduce labor force dynamism. Younger cohorts carry higher tax burdens while receiving fewer benefits. Intergenerational tension grows quietly, expressed through shifting attitudes toward work, ownership, and participation. The promise that each generation will be better off than the last weakens, replaced by a more defensive social contract focused on preservation rather than advancement. Technological progress continues, but its macroeconomic impact diminishes. Innovation improves efficiency at the margins, but does not translate into broad-based productivity gains. Gains are concentrated, captured by capital, and absorbed into existing structures rather than reshaping them. Technology stabilizes the system by making it more efficient at managing scarcity, not by creating abundance. Global coordination becomes harder as national priorities diverge. Countries facing similar constraints pursue different strategies based on political culture, institutional capacity, and geopolitical position. Some lean toward protectionism, others toward liberalization within guarded frameworks. Capital flows adapt, favoring jurisdictions perceived as stable rather than dynamic. The global economy fragments further, not into hostile blocks, but into insulated systems managing decline at different speeds. In this phase, crises do not disappear, they change character. Instead of singular, overwhelming events, they arrive as overlapping stresses. Fiscal pressure combined with social unrest, financial volatility alongside geopolitical tension, environmental disruption layered onto existing fragility. Each stress is managed, contained, and deferred. None is fully resolved. The system survives by absorbing shocks sequentially rather than collectively. Public perception evolves accordingly. Confidence is replaced by cautious acceptance. Expectations adjust downward. Economic success is redefined as continuity of service, avoidance of extreme outcomes, and maintenance of basic living standards. Ambition retreats from the collective sphere into the personal. Individuals focus on securing their own position within the system rather than improving the system itself. For markets, this produces a regime of constrained returns and persistent uncertainty. Volatility remains suppressed until it is not. Asset prices drift rather than trend. Valuations reflect endurance rather than optimism. Capital preservation strategies proliferate. Financial innovation focuses on hedging, protection, and arbitrage rather than growth. The market becomes a mirror of the broader economy, functional, complex, and inward-looking. None of this implies imminent collapse. Systems can persist for long periods in states of managed decline. History offers numerous examples of economies that endured stagnation without dramatic failure. What distinguishes the present moment is scale and synchronization. Never before have so many large economies operated under similar constraints at the same time, with limited external engines of growth. The endgame, therefore, is not a single reckoning. It is an extended negotiation with limits. Each year, the range of feasible choices narrows slightly. Each intervention solves a problem while creating new dependencies. Each success raises the cost of reversal. The system becomes path-dependent, not because it chose a destination, but because it avoided turning back. Clarity emerges only gradually. Not through crisis headlines, but through accumulation of small signals. Declining trend growth, rising fiscal rigidity, persistent affordability issues, and institutional fatigue. These signals do not provoke immediate action because none is catastrophic. Together, they redefine what normal means. At this stage, the most important change is psychological. The belief that the system will naturally correct itself fades. In its place arises an understanding that outcomes are managed, negotiated, and constrained. Economic life becomes less about opportunity and more about navigation. This does not mark an end in the dramatic sense. It marks a transition from expansion to maintenance, from growth to stewardship. Whether this transition leads to renewal or prolonged stagnation depends not on markets alone, but on collective willingness to confront trade-offs openly rather than defer them invisibly. The illusion that once sustained confidence has fully dissolved. What remains is choice under constraint. And while constraint limits possibility, it also clarifies reality. The future of the global economy will not be defined by how long stability can be preserved, but by what societies decide is worth preserving once stability can no longer promise progress. The global economy is not about to collapse, but it is no longer correcting itself. It is being managed, stabilized, and prolonged at a growing cost that is quietly shifted onto society in the future. The question is no longer whether this system works. It is who it works for and how long it can continue this way. If you want to understand what comes next, you have to stop watching the headlines and start watching the structure beneath them. Because when stability is manufactured, it is not permanent. And when the illusion fades, the adjustment does not ask for permission. Stay aware, stay skeptical, and remember, the calm is not the proof, it is the warning.